Okay, so last night we talked about tax-advantaged accounts. The basic idea that certain investment accounts come with a government deal attached. And a lot of people messaged in saying, wait, so which account do I actually use? Like, I have a 401k at work, my friend keeps telling me to open a Roth, my dad says max the 401k first. Everyone has an opinion.
And the frustrating thing is, everyone giving that advice is probably right for their own situation. The problem is, they're handing you the answer without the map. You don't know why it's the right answer, so you can't know if it applies to you.
So before we go any further, what exactly are people going to understand by the end of tonight?
By the end of this, you will know exactly which account makes more mathematical sense for where you are right now. Not in theory, for your income level, your tax bracket, your actual life.
I like that. Okay, so let's back up 1 second. For anyone who missed last night or who is, just joining us at midnight because they can't sleep and somehow ended up here.
Welcome. You picked a good night.
Truly. So, very quickly, these accounts are both just containers, like a lunchbox. The lunchbox isn't the food, it's just what you carry the food in. What you put inside, stocks, funds, whatever, that's the food.
Right. And the government cares very much about which lunchbox you use because the lunchbox determines when and how they get to take a bite.
Okay, the government taking a bite of your lunch. That is genuinely the most accurate metaphor for taxes I've ever heard.
So the core question tonight is not which account is better in some universal sense. The question is, do you want to pay taxes on your money now before it grows or later after it has grown into something much bigger?
And the terrifying thing is, that decision made once in your 20s or 30s can mean a difference of literally hundreds of thousands of dollars by retirement. Not because you invested more, because of when the government took their cut.
That's the hidden tax math. And most people never see it because they're focused on the investment return, how much the account grows, when the real leverage is in the tax timing.
Okay, so let's define the two players clearly. 401k first. What is it in plain English?
The traditional version is offered through your employer. Contributions come out of your paycheck before taxes. The government doesn't touch that money today. It grows, and when you retire and withdraw it, that's when you pay income tax.
So it's a tax delay. You're not avoiding taxes, you're pushing them forward.
Exactly. And the Roth works the opposite way. You contribute money that's already been taxed. It grows completely untouched by the IRS, and when you retire and pull it out, you owe nothing. Zero.
So the Roth is pay now, keep everything later. The 401k is pay nothing now, settle up later.
That's it. That's the entire structural difference. Everything else, the numbers, the strategy, flows from that one distinction.
Okay, so Act 2, the math. Show me the numbers, but make them human, because I've seen the spreadsheets and my eyes just slide off.
All right, here's the analogy I want you to hold on to. Imagine you're a farmer, and you have a choice about when to pay tax on your harvest.
I'm a farmer, got it. I have a hat.
Option 1, the government taxes your seeds. You plant 100 seeds, they take 25 of them before anything goes in the ground. You only plant 75, but everything that grows from those 75 seeds, yours forever.
That's the Roth. Tax the seeds, the money you put in, not the harvest.
Right. Option 2, the government lets you plant all 100 seeds, no tax up front. But when harvest comes, when your field is full and everything is multiplied, they show up and take 25% of everything, the seeds and all the growth.
So with the traditional path, you get the full field to start, but the government becomes a silent partner in your eventual wealth.
Now here is where it gets genuinely interesting. If your tax rate is the same when you plant as when you harvest, if you're in the same income bracket at 25 as you will be at 65, then mathematically it doesn't matter. Both accounts produce identical results.
Wait, really? They cancel out?
Purely mathematically, yes. The timing shifts, but the total tax paid is the same, which means the entire strategic question is simply, will you be in a higher tax bracket now or later?
And that's the question most people never think to ask.
Most people assume they'll be in a lower bracket in retirement because they'll be earning less, and that used to be mostly true. But here's what breaks that assumption. If you've been saving and investing consistently for 30 years, your account balance at retirement could be enormous. Your required withdrawals could push you into a higher bracket than you're in right now.
So the people who save the most could actually get punished the most in retirement by the tax timing.
That is a real scenario, particularly for people who maxed out traditional contributions for decades. And there's a second factor nobody mentions. Tax rates themselves can change. We don't know what the government will charge in 2055, but the Roth locks in your rate today. Whatever taxes you paid when you contributed, that's settled. No further claim.
So the Roth is also a hedge against future tax policy. You're essentially buying certainty.
Exactly. Okay, now the income angle, because this is where the choice actually narrows for most people based on where they are financially right now.
Right, because there are income limits on the Roth. You can't just choose it freely if you earn too much. Alex, break that down without making my brain hurt.
As of 2024, if you earn under roughly $93,000 as a single person, you can contribute the full $7,000 a year to a Roth. Between $93,000 and $146,000, you get a reduced amount. Above that, the direct contribution option disappears entirely.
And the employer-sponsored version has no income limit. Anyone with access through work can use it regardless of earnings.
Correct. So if you're earning under $90,000 with full Roth access and you believe your income will grow significantly over your career, locking in today's lower tax rate is genuinely powerful. Earning over $150,000, the traditional path becomes primary, though advanced strategies exist to still access Roth benefits. Future episode.
Okay, so we have the mechanics, we have the income picture. Now let's make it real, because I think people hear this math and nod along and then do nothing. So give me the historical proof. Show me this actually mattered for real people.
All right, let's go back to 1998, the year after the Roth was created. Most advisors told clients to stick with traditional accounts. The new option was unfamiliar and required paying taxes up front, which felt like a loss.
Because paying taxes feels like losing, even when it's strategically smart.
Exactly that psychological trap. Now imagine two 28-year-olds in 1998. Both earn $45,000 a year. Both invest $2,000, which was the annual Roth limit at the time. One puts it in a traditional IRA, paying no tax now. One puts it in a Roth, paying the tax up front at roughly 15%, so about $300.
And they both invested in something that tracks the 500 biggest companies in America, historically growing at roughly 10% a year before inflation.
Right. Fast forward to today, 26 years later. That $2,000 growing at an average of 10% annually is now roughly $23,000. The traditional IRA holder pulls it out. They pay income tax on the full $23,000. At a 22% bracket, common in retirement for moderate savers, they hand over roughly $5,000.
So they net about $18,000.
The Roth holder pulls out $23,000, pays nothing, keeps everything. The $300 they paid in 1998 protected over $5,000 of future wealth. That's roughly a 17-to-1 return on the tax they paid early.
And this is just on $2,000. Scale that to someone maxing out every year for 30 years at 10%, the gap becomes, I don't even want to say the number out loud at midnight.
The gap on a fully maxed out Roth, $7,000 a year, every year for 30 years at 10% versus the same dollars in a traditional account with a 22% withdrawal tax rate is roughly $350,000, kept, not paid to the government.
$350,000 from one decision made once.
And there's a real human story here. Peter Thiel, the PayPal co-founder, reportedly held startup equity in a Roth. The shares were essentially worth pennies when he bought them. By the time PayPal went public and those shares exploded in value, all of that growth was sheltered, completely untaxed.
Okay, that's an extreme case. Most of us are not buying pre-IPO startup stock, but the principle scales down perfectly. Even boring, diversified growth shielded from taxes compounds into a meaningfully different retirement.
That's the move. You don't need a billion-dollar outcome. You just need time and a tax-free container.
Okay, I want to push back now because I've been nodding along and I think our listeners have too. But I want to channel the person lying in bed right now thinking, sure, but What are the real objections here?
Good. Let's hear them.
Objection 1. My employer matches 50 cents for every dollar I put in, up to 6% of my salary. That's essentially free money. Why would I skip that to fund a Roth?
You wouldn't, and you shouldn't. The employer match is the single best guaranteed return available. If your employer matches 50 cents on every dollar, that's an instant 50% return before any market growth. Nothing beats a guaranteed 50%.
So the order is, first, contribute enough to capture every dollar of the employer match. Then, open and fund a Roth. Then, if you have more to save, come back to the traditional account.
That's the standard playbook for most people under 6 figures in income. The match first, Roth second, 401k overflow third.
Ha, okay, good, because I was a little worried you were about to tell people to leave free money on the table. Objection 2. I'm barely making ends meet. Retirement feels like a problem for future me. I can't think about tax brackets 30 years from now when I have rent due next week.
That objection is real and deserves a real answer. Here's the thing. Unlike almost every other retirement account, you can withdraw your original Roth contributions, not the growth, but the money you actually put in at any time, without penalty, without taxes, because you already paid taxes on it.
Wait, so the Roth has a kind of emergency flexibility built in?
Exactly. If you contribute $5,000 this year and your car breaks down in 6 months, you can pull that $5,000 back out, no questions asked. The growth has to stay into retirement to remain untaxed, but the seed money is always accessible. That makes this option uniquely suited for people nervous about locking money away forever.
So the psychological barrier of I can't afford to lock this up, that's actually partly a myth when it comes to the Roth specifically.
Partly, yes. The fear of irreversibility is real and it stops people. But the Roth has more flexibility than most people realize. The one thing I'd still say, only invest money you genuinely don't need in the short term. The goal is to never touch the contributions either. Let everything grow. The flexibility is a safety net, not an invitation.
And the final psychological wall I see all the time, decision paralysis. People know they should do something, they just can't decide which thing, so they do nothing, and nothing compounds beautifully into nothing.
The cost of waiting isn't just the returns you miss, it's the contribution room you lose. There's a use it or lose it annual limit. If you don't contribute in 2024, that year's $7,000 of room is gone. You cannot go back and fill it later.
Alex, you know it's amazing. You said that completely calmly, and it is objectively a terrifying piece of information.
I found calm delivery makes the terrifying things land harder.
Genuinely effective. Okay, action plan. Let's make this real for the person who just absorbed all of this and wants to know what to actually do tomorrow morning. But first, does the strategy change based on where you're starting?
It does. Let me split it into 2 starting positions. First, if you have no retirement savings yet, nothing, starting from 0.
That's a lot of our listeners right now, I'd guess.
If you're starting from 0 and your income is under $90,000, your move is to open a Roth this week, not next month, this week. Fidelity, Vanguard, or Schwab, about 15 minutes online. Link your bank account, set a recurring monthly transfer of whatever you can manage, even $50. Then invest it in a single target date retirement fund, which automatically adjusts its risk as you get closer to retirement. You don't need to pick stocks. You just need to start.
A target date fund. Think of it like a slow cooker for your retirement. You set it, you walk away, it manages itself over decades.
Perfect analogy. Okay, second starting position. You already have something saved. Maybe a couple thousand through work, maybe 5,000 in a savings account. Now what?
Now you optimize.
Log in to your work account tomorrow and check 2 things. 1, are you contributing enough to get your full employer match? If not, raise your contribution percentage to that threshold. 2, check what you're invested in. If you see high-fee, actively managed funds, anything charging more than about 0.5% annually, switch to the lowest-cost diversified option available. Usually it'll have Index or S&P 500 in the name.
And that fee thing is not small. A fund charging 1% a year versus 0.05% over 30 years on $100,000 costs you roughly $170,000 in lost compounding, from a number most people don't even look at.
Then, after your match is secured, open or fund a Roth alongside it. The goal for most people under 50, capture the match first, then max the Roth, then traditional contributions again if there's room. That sequence gets free money first, untaxed growth second, and tax-deferred overflow third.
So the 3 micro actions for tomorrow morning, just so people have something concrete to write down or screenshot.
1. Log in and confirm you're capturing the full employer match. If not, increase your contribution today. 2. Google Open Roth IRA Fidelity or Vanguard or Schwab and spend 15 minutes starting the application. You don't need to fund it today. Just open the door. 3. Check expense ratios on your current investments. If anything is above 0.5% annually, find the low-cost equivalent and make the switch.
3 things. No spreadsheets required, no financial advisor needed, just 3 tabs open tomorrow morning with your coffee.
The math will do the rest. That's the whole point. You don't have to be smarter than anyone. You just have to set up the right container and let time work.
And speaking of what goes inside these containers, tomorrow night we're going into something that makes a lot of people anxious, but really shouldn't. We're talking about how diversified funds quietly outperform most professional investors, and why doing almost nothing turns out to be the winning strategy. It sounds too simple. Alex is going to prove that it isn't.
It is both very simple and profoundly counterintuitive simultaneously.
If that has you curious, hit subscribe so it's waiting for you tomorrow night. And for now, let the information settle. You've already done something tonight that most people don't do. You thought carefully about your future. That matters.
Sleep well. The compounding continues whether you're awake or not.